Good morning, everyone. We're going to talk about the in-class problems today. There are 6 of them that I set up for Chapter 4 that we're going to do as a review based on student questions. This particular concept actually looks at the learning objective 4-9, understanding the impact of consolidated financial statements when a step acquisition takes place. So on January 1st, PACA acquired 70% of Sellinger's shares for $1,405,506,000. The price was paid proportionate to the total fair value, although at the acquisition date, Sellinger's book value was $1,650,000. All assets and liabilities assumed fair values equal to the book values, except for a patent with 6 years remaining life that was undervalued by $348,000. On January 1, PACA acquired 25% stock interest in the company for $553,750 in cash. On its internal records, it uses the equity method for accounting for the shares of Sellinger. During the 2 years following, you have the net income and the dividends declared. Part A requires us to show the journal entries to record as of January 1st, 2018, with an acquisition of an additional 25% ownership in Sellinger's shares. Part B requires us to prepare a schedule showing PACA's December 2018 equity method balance for investment in Sellinger's account. So here, because we have 2 methods, we have to look at the acquisition of the 25% and the equity method for the balances. So part A is the journal entries. The actual investment for Sellinger was $578,750. The cash was $553,770, and the additional paid-in capital was $25,000. In order to do that, we had to get the acquisition date fair value, and we were told it was $1,405,600, sorry. And it tells us that here in the problem, that's 70% of their outstanding shares, what they purchased it for, is what we use to do the calculation, divided by 0.70. And it's important when you calculate these to follow that. That gives you an acquisition date fair value, $2,008,000. Sellinger's net income as of 2017, okay, 553. Sellinger's net income was $555,000. We had the excess fair value amortization of $58,000, the dividends of $190,000. From that, we have an adjusted subsidiary value as of 12/31/17 of $2,315,000. They acquired 25%, because it tells us here, in the common stock. With the acquired 25%, the acquisition date based value for the newly acquired shares is $578,750. The acquisition price for 25% interest, $553,750, with a credit to APIC of $25,000. Here are the entries associated with that calculation. For required part B, we look at the initial value, again, the purchase price. We have the subsidiary net income of $347,900, the dividends, the acquisition date shares fair value, adjusted subsidiary net income, subsidiary dividends for 2018, and then your new investment for 2018, and that is calculated with the initial value of acquisition, 70% of the adjusted 2017 subsidiaries net income, your 550,000 minus your 58. 70% of the dividends, 133, adjusted fair value, 578, 750. Then you have the 90% adjusted subsidiary net income, 683 minus the 58, which is 593, 750. 95% of the subsidiaries dividends, because you had a change in value, 218,500, which gives you the investment and Sellinger of $2,574,500. So these are the calculations for the first problem. And again, we were looking at the impact of consolidated financials when the step acquisition takes place. It's one of the most difficult concepts in the chapter. And you had a 70% acquisition, and then you had the 95% adjustment. Okay? We're going to move on to the next question, hopefully. Maybe. All right, finally, guys, where we are going to look at the calculation for 4 non-controlling interest figures included in the consolidation process when you have non-controlling interest. And we talked about non-controlling interest a lot. So on January 1, Beckman acquires 60% of the outstanding stock of Calvin for $557,732. Calvin has one asset recorded for a specialized production machine with a book value of $10,300 and no liabilities. The value of the machine is actually $82,300, and it has a remaining useful life to be estimated over 10 years. Any remaining excess fair value is attributable to an unrecorded process trade secret with an estimated future life of 4 years, and the total acquisition date fair value is $96,220. At the end of the year, they reported the following on their financial statements, and it gives us revenues, expenses, income, dividends paid, the machine, other assets, our total assets, our common stock retained earnings, and total equity. We need to determine the amount that Beckman should report in the year-end consolidated statements for controlling interest of a subsidiary's income, non-controlling interest, and Calvin's machine's net accumulated depreciation, and the process trade secret. So the non-controlling interest in the subsidiary is $11,088. Controlling interest is $47,576. The machine net accumulated depreciation is $74,070. And the process trade secret is $10,440. For this particular problem, our explanation is as so. The first thing we have to do is look at our fair value. The fair value is given as $96,220. There was a change in book value of $10,300 for the specialized machine that has to be recognized. The fair value in excess of the book becomes $85,920. The actual machine was worth $82,300. You have to take away the $10,300. That accounts for depreciation at 10 years, okay, $7,200 per year. 4 years for the trade secret, $3,480 per year. The total adjustments, $10,680 per year. Your trade secret is $13,920. For the consolidated figures, non-controlling interest in the sub is 40%, okay? At 40%, the $96,220 gives you $38,488. And the income allocation is $11,088. A dividend reduction of $2,000, which is the 40% of the $5,000, gives you a year-end non-controlling interest of $47,576. At the very bottom here, it shows you how they calculated the machine net. That was $74,070. That's the $9,270 plus the book value of $72,000 minus the allocation, excess allocation less the $7,200 in expense depreciation for 1 year, which is here. And then the process trade secret is calculated as $13,920 minus the $3,480, which is $10,440. Let's hope we have better luck with problem 3. Problem 3 is actually asking you to identify the placement for the company's non-controlling interest on a financial statement. So here, you're given a worksheet, and Plaza acquires 80% of the common stock as of January 1st. In exchange, it gives $955,900. At the acquisition date, total fair value, including non-controlling interest, was assessed at $1,194,875. Also at the acquisition date, Standard's book value was $525,400. Several individual items on Standard's financial records had fair values that differed from their book values. You can see here that each of these had a different fair value than the book value. For internal reporting purposes, Plaza Inc. employs the equity method, and here are the following balances for the year end. You have your revenues, cost of goods sold, amortization expense, and equity and standard to give you the net incomes. Then you have your retained earnings, net income, and dividends declared as of 12/31/18. Your current assets, which includes the investment in standard, trade names, property, equipment, patents, to get your total assets. And then your accounts payable, common stock, and additional paid-in capital, as well as retained earnings to get your total liabilities and equities. At year end, there were no inter-entity receivables or payables, so it tells you don't have to worry about the IMP. And then it asks you to prepare the worksheet. Here you can see the worksheet preparation that's required and the debit and credit entries that go along with those. We had entries for depreciation expense, amortization expense. We had to deal with the equity and Stanford, of $296,936. We had the NCI share of the CNI, the retained earnings of $430,000, dividends declared for non-controlling interest, that's my fault, investment in Standard, trade names, property and equipment, patents, goodwill. We had adjustments for common stock, paid-in capital, non-controlling interest adjustments, and then we had the entry for the liabilities and equity. On the consolidated totals, you can see where the adjustments were made. For your revenues, you have a new total, depreciation, amortization, and if you look at your consolidated net income, you can see where your position was there. You can also see your retained earnings, net income, and dividends declared to give you the retained earnings for 12/31. Your current assets, including your trade names, your equipment, patents, and goodwill to give you your total adjusted assets. Accounts payable, common stock, additional paid-in capital, non-controlling interest, and your retained earnings to give you your total liabilities and equity. Here are the calculations that go along with all of that and how they arrived at that information. Here you can see the NCI share was 73,400, making the adjustment to 469.9. You have the investment in Stanford, and how the adjustments were tied to each of those. The fourth question for this week addresses the effect of consolidated financial statements on a control premium paid by the parent. On January 1st, Holland paid $7 per share to a group of Zeeland Corporation shareholders to acquire 60,000 shares of Zeeland's outstanding voting stock, represented by 60% ownership, and the 40,000 remaining shares of Zeeland continue to trade in the market and close to its recent average of $5 per share. And after the acquisition date by Holland, Zeeland's acquisition date balance sheet is as follows. So here we have the current assets, property and equipment, patents, liabilities, common stock, and retained earnings. On January 1st, Holland assesses the carrying amounts of Zeeland's 5-year remaining life to be undervalued by $62,000. Holland also determined that Zeeland possesses an unreported patents with 10 years remaining life worth $226,900. Zeeland's acquisition date fair values for its current assets and liabilities were equal to the carrying amounts, and the remaining asset as of the fair acquisition date over its book value will be attributed to goodwill. And here we have the financials that go along with that. Again, at year end, there were no payables or receivables. So first we have to compute the amount of goodwill recognized in the acquisition and allocate the goodwill to the controlling and non-controlling interest. So our calculation for goodwill, our goodwill allocation, and then our investment in Zeeland. And we arrive at the non-controlling interest of a presence of a control premium by looking at the consideration transfer, the 60,000 shares at $7, which is $420. The fair value of the non-controlling interest, $5 per share for the remaining 40,000 shares, with a total of $620,000. Zealand's book value as of January 1st was $200,000. The excess acquisition date over fair book value, $420,000. The equipment with 5 years remaining life of $62,000. And the patent of 226 gives you 288, giving you goodwill of 131,000. Again, that's your calculation for goodwill. Okay. When we have to look at our allocation, we look at the acquisition date fair value for Holland and NCI, 60 and 40. Allocation of goodwill is $126,660, and $404,440 for the non-controlling interest, making our total investment in Zealand $559,032. We look at the net identifiable assets as the fair value. Our current assets were $14.7, property and equipment $208.7 and $62, the patents $199.1 and $226.9, $426. Our liabilities were $222,500. Here. For a fair value of net identifiable assets of $488,900. That's our identifiable net assets. Then we have to look at our investment in Zealand. Again, our initial value was $420,000. We had a change in Zealand's RE, 60%, the 402.4 minus the $100,000. Plus your amortization. So your investment in Zealand as of 12/31/18 is $559,032. Equity in Zealand's earnings, your net income was $117,000. Your excess fair value amortizations have to be removed. Adjusted net income becomes $81,910. You have 60% ownership, which means your equity in Zealand's earnings, the portion you're entitled to, is $49,146. The third part of this is the actual requisition and your consolidated totals. For this particular piece of the problem, I'm going to show you the consolidated totals and how they're consolidated. This has come up in a number of problems. The only difference in this one and the previous one I showed you guys is that you have to account for the non-controlling interest in the consolidated financial statements, which is the 32,764, the 12. And then you have your non-controlling interest here to get your total liabilities and equity. And that is calculated as the net income minus the excess amortization and depreciation to get your total adjusted net income of $81,910. And your controlling interest attributable to the non-controlling interest is $32,764. So we looked at Zealand's earning per share and the equity, which is the $49,146, and the second part of this problem is $32,764. Our next problem looks at identifying the calculations of 4 non-controlling interest figures that must be included with the consolidation process. Again, same concepts. Here, Miller Company acquired 80% of Taylor, January 1, 2016. They paid $920,000. The remaining 20% shares of Taylor continue to trade at a total value of $230,000. On January 1st, they reported a book value of $564,000, common stock $282, paid in capital $84, retained earnings $197.4. Several of Taylor's buildings had a remaining life of 20 years and were undervalued for $75,100. The next 3 years, Taylor reports and declares dividends as follows. What we're asked to do is determine the amount of excess depreciation in the initial years following the acquisition, consolidate the balance sheet. If a consolidated balance sheet is prepared January 1, 2016, what amount of goodwill should be recognized? If the consolidation worksheet is prepared, what entries S and A should be introduced? And on a separate financial record of the parent company, what amount of income would be reported for 2016 under the following methods: equity, partial equity, and initial income method. On the parent separate financial records for December 31st, 2018, the balance and investment in Taylor Company using all 3 methods. As of December 31st, Miller's building accounts on a separate record has a balance of $764,000, and Taylor has a similar account with a balance of $286,500. What would the consolidation be for the businesses? What is the balance of the consolidated goodwill as of December 2018? And assume the parent company has been applying the equity method to this investment. On December 18, the separate financial statements for the 2 companies present the following information. Common stock, paid in capital, and retained earnings. A and B require us to look at the amount of excess depreciation and goodwill. In order to do that, we have to calculate the fair value of excess amortizations. We need the consideration transferred, the non-controlling interest. Taylor's fair value is arrived from that. The book value, giving us the excess fair value as of the book date. And then we look at the excess fair value of the buildings. We have to do the amortization on that. And then we get indefinite goodwill here of $510,900. So our total excess amortization is $3,755. Our goodwill is $510,900. Part C wants us to do the consolidated entries for the worksheet. We have to have our investment in Taylor, which is 80%, then our non-controlling interest, which is 20%. There is no control premium for entry A. So you have your investment in Taylor at 80% and your non-controlling interest at 117%. I'm sorry, at $117,200. And those are the identifiable entries. For D and E, it asks us to look at the equity method, the partial equity method, and the initial value method. Under the equity method, you have income accrued at 80%, excess amortization to give you your investment income. For the partial equity method, you have accrued income. For the initial value method, it's 80% of the dividends received, okay? Under the equity method for Part E, you have to have your initial fair value paid. You have your income accrued from 2016 to 2018, which is $246,000 times 80%, their share. The dividends is the same thing, their share. The excess amortization, 3 years of the $3,004, which is the excess amortization expense. Your investment in Taylor is $1,073,948. Under the partial equity method, the investment by Taylor is initial value paid plus accrued income of $197,000 less the $34,320. There are no excess amortizations. Under the initial value method, again, your original price paid. F and G. Consolidated balances as of December 31st, 2017, and consolidated goodwill as of December 31st, 2018. In order to arrive at those, using the acquisition method, the allocation will be the total difference, the $75,100 between the building's book value and fair value based on the year's remaining life with an annual excess amortization of $3,755. Your book value is $764,000 for Miller, 80%. Taylor's $286,500. Your allocation of $75,100. Excess amortization $4,000 times the 2 years, $7,510. Your consolidated building account will be $1,118,090. Pay close attention to this number right here, guys. And look for how they arrived at 7,510 versus the 4,000 times the 2 years, okay? For H, it asks us to determine the common stock, additional paid-in capital, and retained earnings. G looks at the acquisition date fair value allocated to goodwill, which was already accumulated and calculated in Schedule 1 above, 510, 900. If the parent is applying the equity method for Part H, the stockholder equity accounting method on his books will already be represented in the consolidation total, and the common stock and additional paid-in capital figures to be reported are the parent's balances only. Also, retained earnings and the equity method will properly record all subsidiary net income and amortization, so the parent's balance is also a reflection of the consolidated total. So while H requires you to give these answers, those answers are already tied to the calculations that were represented in the consolidation totals. And now we will move on to our last problem. Which requires us to look at and understand the impact of a mid-year acquisition. And again, we have to look at our consideration transfer, okay? So for A, we have consideration transfer, non-controlling fair value, Atlanta's acquisition date, then the book value, the excess fair value, and then the patent and the goodwill. Consideration transferred, non-controlling interest. And once again, we have to do the excess amortization to calculate our goodwill. For Part B, we look at our controlling and non-controlling interest, which simply is the fair values minus the relative fair values of the identifiable assets at the 70-30 split. That's the $1,040,500. And in this scenario, goodwill is attributable to both the controlling and the non-controlling interest. For Part C, you're asked how Truman derived the investment in Atlanta balance at the end of the year 2018. We had the initial value at the date of acquisition, Truman's shares of net income, the dividend that was paid, and the investment balance as of 12/31/2018. C is calculated as, again, the initial value, Truman's share of Atlanta's income for half of the year minus the amortization, dividends half the year at 70% to give us the investment. Part D requires us to complete the worksheet. Again, we have entries much the same as in the previous problems, and we have to take into account our controlling and non-controlling interest, with only entries for the non-controlling interest showing up in that column. And in doing so, we have net income attributable, dividends declared to the non-controlling interest, and the total to give you your non-controlling interest as of 12/31 to get your consolidated totals. Okay, guys, these are the problems that I selected for this week. These are very complex problems. Remember that when we're testing, we will use a smaller volume of problems that look at individual concepts. For example, one problem may be Part A, and then you may have an entirely different concept for Part C. Each of these is repetitive in some way. The work is massive, but what they're trying to get you to do really is simply recognize the difference in between those concepts. And I did pick some really hard questions that were multiple levels for this week so that you would get a chance to see how they are actually worked. And again, you can review these, multiple times. They're not graded, so if you only want to work one particular piece of it, then you can do that as well. All right, I think that takes care of everything for today. I will upload this later today, and hopefully you guys gain some benefit. Thank you.